Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders Weekly for the week of July 21st. It's just myself, Sprocket888, this week, and we are going to take a look at premium selling basics. Before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. You'll also find a link to thetagang.com/Sprocket888, where I post each and every one of my trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. If you can't find it there, let us know and we will get it there. But let's hop to this week's content. Premium selling. Now, this is something that I routinely talk about all the time on this channel. Constantly going through earnings trades, setups in particular, premium selling, and there's been a few episodes way back in time where I kind of went through some of this is what this is. So we're going to go through kind of a brief recap of that as a refresher to those of you that maybe missed out on that episode a long time back. Now, whenever we talk about buying something, there's a transaction at hand, and a transaction always involves a buyer and a seller. Now, in this case, I always talk about selling premium because I am the seller when I'm doing that. However, in order to understand better what is going on, I want to flip and take a look at what the buyer is. What are they looking for? What are they after? What are they doing in that transaction? And the best way that I like to describe this is I like to think of options contracts or premium selling as effectively insurance contracts. And if you think about insurance, what is insurance? Insurance is a premium, a price that you pay in order for some kind of protection. So, stock market aside, you probably all have car insurance if you have a car, as it's the law to carry car insurance. And you pay money every month or every 6 months or annually to your insurance carrier for your car insurance. Now, if you never need a car repair, that is all dollars and money that have gone into a bucket of your insurer. And you pay that money in hopes, or not in hopes, but in the event that something were to happen to your car, that insurer is on the hook for making you whole again on your car, whether or not that's the repairs in the car, any sort of injuries that might be sustained, or any of the consequences of any sort of automotive accident. That's what car insurance is. There's insurance for all kinds of things. You have hurricane insurance, flood insurance, earthquake insurance. All of these things are basically premiums that you pay, you the buyer pay, in order to protect you from catastrophe. And that is exactly the same when it comes to options contracts out there in the market. The options contract is simply premium that is to protect the buyer from either an upside move or a downside move. And you might say, what do you mean protect you from an upside move? And what I would say there, downside move is pretty straightforward, right? If the stock falls below a certain point, you don't need to worry about it because you can guarantee that you can go to the person that sold you that insurance contract and they will buy that stock for whatever that insurance premium is that you sell. And we'll talk about that in a minute. But what is the upside protection? And the upside protection that a buyer might do here is more of like a speculation. So they can buy a contract that says, hey, I want the right to be able to purchase shares at some price higher than where the stock is now in case it goes by there. And so what you're protecting yourself against is the missing out on gains. So, let's say we have Apple stock. Apple, I'll use this as an example quite a bit. Let's say it's trading at $100 and you think, what if it goes to 130, 140? You don't want to miss out on that upside. So you might buy a call at, let's say, $110. You're going to pay a premium for that call. But should Apple move upwards in that direction past that strike and continue on to your 120 target, your 130 target, whatever it is, you have insurance that says, You didn't miss out if you didn't buy the shares, because that contract that you purchased says you are allowed to purchase those shares at that $110 strike if that happens to be the strike that you put. And so that, or purchased. And that is what it means by protecting you to the upside. It allows you to protect from missing out on gains. Now, a lot of what options are traditionally used for is really that downside protection. So a lot of times they are purchased by large shareholders of stock, and they will buy the option that is well below or a little bit below where their current holding is, that says, look, if the bottom falls out of this thing, I want to make sure that I will get at least X dollars, whatever that is. So in the Apple example, maybe they purchase a put at $90. And what that means is if the stock drops below $90, it doesn't matter. They are allowed to sell their shares to whoever sold them that option contract for $90, no matter how low that stock is trading. Now, I dropped two words in that last description, puts and calls. And these are very important because options contracts come in those two flavors. There is the flavor of the calls and there is the flavor of the puts. So what exactly is the difference between a put and a call? Because it's kind of confusing and then words don't make a ton of sense on the surface. But if you actually look at them and you think about what it is that they mean, this is easier to remember than you might think. And so the first thing is a put. So always think in terms of the person who is purchasing the option, because the one that purchases the option, the buyer of the option, has all the power of the option. They're the ones that are determine the fate of that insurance contract. And the word put, the type of option contract that is a put, gives the buyer the right to put shares to the seller of the option at the agreed upon price. So in the example of Apple, a $90 put gives the option holder the right to put 100 shares of Apple to the seller of the option for $90. Doesn't matter what the Apple is trading at, the seller of that option must purchase those shares at $90 if the holder of the option, the buyer of the option, chooses to exercise them. So put means to put shares to someone. The other type of option contract is a call. And the way that you think of this is a call gives the holder of the option the right to call away from the seller of the option at the agreed upon price. So in the example of Apple, I talked about a $110 call. That means that whoever purchased that coupon, that insurance contract, they have the ability to call away 100 shares of Apple for $110. So the sizes of all the option contracts are 100 shares. That's why I keep saying 100 shares. So remember, call is to call away from somebody, and put is to put the shares to them. And this is all relative to the option holder. So if the option holder is holding a put, they have the right to put 100 shares to the seller. If the option holder, the buyer, has a call option, they are allowed to call away from the option seller 100 shares. Put to put to call away from. Now, that's all well and good. Now we have some of the basics out of the way, but where does this premium come from? What are you actually selling? What determines the price of that option? And that is where a thing comes in called intrinsic and extrinsic value. And what I want to call out here is every option has two components to their price. It has an intrinsic price and an extrinsic price. Intrinsic means built in. It is intrinsically there. It cannot be taken away. That is the value in the option that is part of the price of the option relative to the underlying stock. So intrinsic value only exists in options that are known as in the money. And so if you have shares of Apple trading at $100, okay, $100 is here, and you have a call selling for $90. That call is below the current price. And that means that the option holder has the ability to call away for $90, but the stock is trading at 110. So the stock is considered $110 in the money. So the difference between the strike price and the underlying price is the intrinsic value. And that only exists when you are in the money. If you are out of the money, then there is no intrinsic value at all. And the option is made up entirely of extrinsic value, value that is derived from outside of the underlying price. Now, every option has extrinsic value. And extrinsic value is made up of many, many components, but we only really need to focus on two here in this episode. Those two values are volatility and time. Now, they're all called Greeks, and there's many, many different things, and we're not going to get into all those things in this episode because the bulk of the premium is derived from two things, volatility and time. Now, let's talk about time first. Time basically means how long is my insurance policy good for? Is my insurance policy good for a week? Is it good for a month? Is it good for 3 months? Is it good for 6 months? Is it good for a year? Is it good for 2 years, right? So the longer that your contract is, the more expensive that it is. If you want to go insure your car for 1 week, you can't really do this, but if you could, that insurance premium will be pretty low because the likelihood of you getting into a car accident in 1 week's time is pretty low. Now, if you extend your car insurance to 6 months, you're going to pay more for that car insurance from a dollar perspective because there are more things that could happen in 6 months versus 1 week. And so the longer that an option contract is out there or good for, the more premium that is built into that. And so as an option contract ages, and this is the beauty of selling premium, that premium of that contract naturally goes down over time. Time is constantly eating away the value of that contract because the insurance period is getting shorter and shorter and shorter. And when the insurance period gets shorter, there's less probability that you'll need that insurance. And so that is where, that time premium is declining. Now, the other part of that premium that I talked about is volatility. And volatility is the change in price. So the more violent and wider swings of price, the more volatile the stock. So you'll find things like tech stocks, growth stocks, very speculative stocks naturally have high volatility because they have big price swings. You will find consumer staples, your Campbell's soup, your, in systems that are not speculative in nature, but more consumer staples and things like that. Energy stocks, utility stocks, things like that, that are much more consistent in their price movement will have much lower volatility. Now, if the price is less likely to be swinging up and down, that is going to make it cheaper to insure. So think of it, a flood insurance or hurricane insurance. If you bought hurricane insurance in Minnesota, it's probably pretty low because there is likelihood of a hurricane in Minnesota is incredibly small. But a hurricane in Florida is much more likely based on the weather patterns. The weather down there is more volatile with respect to hurricanes. And the same goes for that in the insurance of these stocks, right? The option contracts. So the more violent that the stock trades, the higher the volatility and the higher the premium. Now, I have up here on a graphic here the Apple's price, saying Apple's $100, and I laid out the puts and the calls and which ones are in the money and which ones are out of the money. So the two contracts that are there with green bars represent those contracts that would be in the money. So a $110 put when Apple is trading at $110 would have $10 of intrinsic value. That is because Apple would be trading at $100, but that put says I can put those shares to you at $110 and you have to buy them for $110 even though the open market could sell them to you for $100. That means there's $10 of intrinsic value. Now, you're $10 away from that strike price. And so I've hypothetically said that when you're $10 away, you're going to have $1.50 in extrinsic value. So that option contract is actually $11.50 in premium, but only $1.50 of it is extrinsic value. If you looked at a $90 put, that says, hey, I will put these shares to you for $90, but the stock's trading at $100. So that is out of the money, because nobody would say, you know what, let me put these shares to you for $90 when they can go on the open market and sell them for $100. They would immediately lose out on $10. So that's why that option is said to be out of the money. So the only cost in that $90 put is that $1.50 of extrinsic value. And that's that insurance premium, right? If Apple's trading at $100 and you want to protect to the downside, you might buy a put to protect your 100 shares that says, look, if it goes below $90, I want to still be able to sell them for $90. Now you're going to pay a premium of that of $1.50. And the person that sold it to you is going to hope that it stays above $90 because they'll get to keep that premium without actually having to fulfill the contract. You know, that goes kind of to the insurer that's selling the insurance. They're going to hope that a hurricane doesn't hit your house, and they're going to keep that premium that you paid them. And that is how they profit. That is how they make money. Now, occasionally, they're going to have to fulfill a claim, and they'll use the money that they've collected over the aggregate of many payers to fulfill that obligation to fulfill the claim. If we go up to the call side that I have here, a $90 call would be considered in the money. Now it's in the money because if Apple's trading at $100 and you have the ability to call away from somebody Apple for $90, that's cheaper. That's better than the price you can get on the open market. So that's why that is considered to be in the money. Now, even though, the $90 put is out of the money, a $90 call is in the money because you have to think about the direction of those contracts. And so if you have the right to purchase shares at $90 when they're trading at $100, there is $10 of intrinsic value in that option. And again, a hypothetical extrinsic value would be $1.50. So that call would be trading for $11.50. So like I said, the insurer's goal is to not have to fulfill the claim. In the same way, the goal of the premium seller is so that they never have to fulfill the insurance claim. So the goal when they sell those out of the money options or in the money options is that they finish out of the money where they're not on the hook for filling that obligation. Now, occasionally, they're going to have to fulfill the obligation. Occasionally, the person that holds that option contract will choose to exercise. And if you're going to go sell these contracts, then you need to be ready to fulfill them. And sometimes that means purchasing the shares. Sometimes that means providing the shares, depending on whether or not you sold the put or you sold the call. You may have to absorb the shares because somebody might put the shares to you, or somebody might call those shares away from you. That brings us to the end of this week's episode, kind of the premium selling basics. In next week's episode, I'm going to talk about how you go and screen for the premium selling plays that are the most probabilistic to make you money and for you to win out as a collector of the premium and not have to hold or fulfill that insurance contract. Now, sometimes you might, but there is a strategy that you can use where you go after those stocks that have, good time to go. So you're paying for insurance coverage of a good, decent amount of time and that are very volatile. So we're going to look for a nice combination of very volatile stock and a decent amount of time that we're going to cover it. And that is going to generate a good chunk of premium, and the goal in selling that premium is you will get to keep what you collected and not have to fulfill to the option buyer that has purchased those to you an exercise right. And that's the ultimate goal. And I'll talk about next week on how we get through and how you screen for that and open those particular trades. Hope you kind of enjoyed this kind of return back to some of the basics. Good luck out there. I hope you find opportunity in what you're trading. And remember, think outside the block.